Given the recent drop in the stock market, I thought I'd take a few minutes today to explain the way SEM's portfolios have handled the recent sell-off in the stock market. Understanding that may give you a little bit of a glimpse into how you may be wanting to evaluate your overall investment portfolio. Now, first off, to put it in perspective, the S&P 500 peaked on October 5th, and since then it's lost about 12% as of the recording today, which is December 19th. And we call that a drawdown. So from the highest point to the lowest point so far, it's lost 12%. Now understand, this is something that is normal. Going back to the 1920s, the S&P 500 loses 10% on average once per year. Now that doesn't mean that it always happens once per year. In fact, if you look at history, the way you got to that one time per year average is you tend to have clumps of time where the S&P 500 lost 10% multiple times. This is the second time this year. If you recall, the first time was in early February of 2018 when the market lost 10% in about 8 trading days. Now, it was kind of a surprise for people because we hadn't had something like that occur since the early days of 2016. Looking back at that, 2015-16 had a clump of time where we had two 10% drops in about 10-month period. And then even in 2014, late in the year, we had a 10% drop. So we really had 3 big drops all clustered together. But then before that, we didn't have a drop until like of that magnitude since 2011 when the S&P 500 lost about 19%. So you can see that when you don't have it happen every year and you have a long break where all of a sudden you think, oh my gosh, I can't believe this is happening, just realize it is normal on average to lose 10%. You should expect at least once every year to see your portfolio drop like that. Now, I don't know what the rest of 2018 is going to bring, but I can tell you it's very likely that almost all investments, including SEM's models, will have lost value when the year closes at the end. But that, as much as I hate losses, remember, my money, my family's money, all of the SEM employees' money is invested right alongside everybody else's. We all hate losses, but it is something that happens when you're investing. Looking back at it, however, 2015, SEM's portfolios in the markets all lost money. Going back further, 2011, SEM's portfolios and almost all investments lost money. And then, of course, 2008, a lot of things lost money. SEM had a couple things that made money, but pretty much everything lost money. Those next years, 2009, big year for the market, big year for SEM. 2012, big year for the market, big year for SEM. And then 2016, another big year for the market, another great year for SEM. I'm not saying that's what 2019 will bring, but we have to remember when you go through a losing year, typically if you're in the right investment strategy, it's not the time to abandon it. It's the time to just remember where it should fall in your portfolio. And so that brings me to the next point that I want everybody to understand is every investment should play a specific role inside of your portfolio. Our AmeriGuard programs, which is a strategic asset allocation that we look at quarterly, had some really bad luck. Going into October, the market had been going strong. Growth stocks had been doing well. Small cap had been doing really well. So we were overweight the things that brought us there. We had a great 18-month performance period. Well, now those things have fallen out of favor. And when we looked at it at the close of September 30th, everything looked to be continuing. Then all of a sudden, October 5th, the market starts falling. And now you're looking at some bad losses with those portfolios and with the overall market. When we look at it again on January 2nd, it may say to pull some money out of the market finally, or it may say to ride it out. And that's the beauty of having a mechanical, quantitatively based approach is there's no guesswork, there's no emotions involved with that. And in addition, if you look at the long-term performance of AmeriGuard, I decided to put up a return to risk chart, risk being the horizontal axis and your potential return being the vertical one, to help us understand where AmeriGuard falls in the whole spectrum, as well as what types of losses we should expect. Now, our most conservative AmeriGuard is the balanced, And we should expect it to lose 20%. It's lost around 10, 11, 12% right now. So we could almost double the losses that we've already had with the balance going all the way out to Ameriguard Growth and Max, which could lose 40 to 50%. So we could see 3 to 4 times the losses that they've already endured. And I'm not saying that to just say, oh, well, no big deal. But I want everybody to understand, in a bear market, that is possible. Now, what Ameriguard's designed to do is something it may do on January 2nd, which is take some of the money out of the markets, but still give you some exposure just in case 2019 ends up being a good year. We want you to be able to be invested. I've put along these buckets across the bottom for you to really understand the role that Ameriguard should play in a portfolio is that long-term money you're not going to touch or money you don't need for 15, 20 years down the road. And even on the balance side, maybe a 10 to 20 year time horizon for that money. So you don't want to sell every time it goes down if it indeed belongs in those buckets. Now, what we've done for most clients is we've added some tactical asset allocation in there, along with our dynamic, which is a monthly economic model, to give you a lot more diversification. Few people can withstand a 30% drop or 40% drop like Ameriguard Growth might bring. So we use the dynamic and tactical models to pull down the risk down this scale. And I want to point out a couple of things. Income allocator and tactical bond, they've only lost about 3% from the high. They're doing their jobs, hardly any risk exposure there. It's designed so that you can feel better that at least a big chunk of your money has gotten out of the markets. It's not going down with the rest of the stock market. And even our enhanced growth, which can lose 35%, it's had a great year. It's only lost about half of what the overall stock market has lost because it's monitored daily and it's pulled a lot of money out of the market. It's averaged between 30 to 60% exposure to stocks for about the last 6 months. But it is still a riskier investment, but it is adding a lot of value for those of you that have that in your portfolio. And then the dynamics, they had some bad luck to start the quarter, and at the beginning of October, the economy was still chugging along. Since then, in the November look that we got for our economic model pulled them back to neutral, so they're holding up a little bit better in November and December than the overall market and then Ameriguard's. What comes up, January 2nd, when the dynamic models get another glimpse at the economy, is really up for grabs right now. My take so far is the economy is still okay. And I think that's the other thing I want you to leave with today when you look at that. If you scroll down after this video, I have some links to some videos I did last week illustrating just how a small change in the growth rate can cause big changes in the overall value of the market. Nothing's really changed since January 1st, 2018. Growth is about where it needs to be. Everything is working like it should. However, people's outlook is shifting, and therefore, because we've gone for so long without a bear market, they're super sensitive to any sort of changes in the growth rate, and that's why we're seeing these losses now. Now, this could turn into a bear market, and that's the final point I want everybody to leave with is you're in the right portfolio if it fits with your financial plan. So if you're not sure, talk to your financial advisor and really drill down into your financial plan and figure out which of the buckets do each of your investments fall in. If you don't have a financial plan or you're not sure, send me an email. There's a link down further in this article. I can get you a free financial plan as a starting point. We can get in contact with your advisor and help you work that out. So the most important thing whenever the market starts going down is ignore all the noise, tune it all out, stay calm, and just remember that most investments play a specific role in the portfolio. It's just a matter of figuring out which role they play.